The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The roller coaster ride for financial markets, it's the loop-de-loop. Alex, live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Boston.
And I'm Alex Steele. Love the loop-de-loops as a kid. Now, definitely not, which definitely sums up the way I look at investing. All right, the S&P is down 0.2%. Does not tell the story, though. It has been quite a ride for the S&P over the last 24 hours, and you can see that reflected in the safe havens. Like the bond market, you get buying in the long end, yields coming lower. Also, the VIX now firmly above 22 after its own volatile session, and gold still right around record highs as well. And this is our setup, Romaine. Like, this is where we're at, headed into Liberation Day. How do you position for that with the uncertainty?
I don't know. The price action has really been all over the place, Alex, and so too are Wall Street predictions for where this market does go next. Some people out there, they are making the case that the new tariffs to be unveiled tomorrow will be a minor blip for returns that will somehow smooth out later in the year. For others, though, they say investors, they're whistling past the graveyard, unable or at least unwilling to gauge the risk that the tariffs themselves and their impact on the economy will be long-lasting.
But I think it's been incredibly clear what the Trump administration is trying to do. I think what's less clear is just amid the constraints, political, legal, economic constraints, how much disruption are they willing to tolerate?
And economic activity right now really is a tale of two cities when it comes to the tariffs. New manufacturing data from the Institute for Supply Management showed factory output contracting in March, particularly for those that make wood products, plastics, and furniture. Factory orders, they slumped to the lowest since 2023, and employment contracted at the fastest pace since September. Investment plans, forget it. They're on pause right now because of the tariff uncertainty. Then you have the other hand, the flip side. Inventories, they surged to the highest since October 2022 as companies stockpiled before their costs go up. And on the consumer level, a surge in buying of new cars as the tariffs could add thousands of dollars to the MSRP over the coming weeks. So the situation right now, maybe it's less about the impact the tariffs will have on the economy and more about how much businesses and consumers, and for that matter, the markets, have prepped for them, Alex.
Prepped, and then what their tolerance is for that uncertainty. I thought it was worth looking at the decline we've seen in the S&P versus the bond market after we saw the worst quarter for stocks in September of 2022. So it's really this panel here you want to pay attention to. Is the correlation between yields and the S&P. So refresher, you have yields moving higher, prices go down. What we've seen is a positive correlation between yields and the S&P. The S&P is moving higher, and so are yields. So prices are lower. It just means that we've seen an inverse in prices for the S&P and for the 10-year yield, which raises the question, is the bond market finally providing that safe haven bid that we haven't seen throughout the beginning of this year or back in June of 2024? Do you finally need that diversification? And if that's the case, how low can yields go, Romaine?
Yeah, 3.8 and change right now on the 2-year and right around on the 10-year, looking at 4.1575, a tight range over the past few weeks, but that could change in a big way tomorrow. Subadra Rajappa joins us right now, head of U.S. rate strategy over at Societe Generale. And Subadra, I know it's difficult to sort of game out where rates go next because we still have to wait for the impact of the tariffs and obviously whatever reaction function we get out of the Fed. But what are you modeling right now? Do you see significant movement in either direction?
So you're right in pointing out that it's very hard to know exactly what the directionality is going to be. I've actually stopped having a strong conviction on what's going to happen over the next week or two. But over the longer run, if you look at the remainder of the year, our call is that yields will gradually decline. We actually have 375 penciled in for the 10-year by the end of the year. So if you are in an environment where there's a lot of uncertainty and inflation is going to tick up because of tariffs, even though it might be somewhat short-term and transitory, ultimately you're going to see the Fed keeping policy on hold till they have clarity on inflation. And that would translate perhaps into lower growth and lower long-end yields. So we're thinking lower 10-year yields and flatter 2/10 part of the yield curve.
How much clarity do you think the market might get tomorrow once we get that announcement from the White House?
That's a very good question. And I think it's really hard to know because I would say that the market's very divided between, some of the participants thinking this is an opening salvo for a negotiated deal and that, we might not, the bark might be louder than the bite. And then on the other end of the spectrum, you have investors who are concerned about 20% tariffs across the board in all the countries, and perhaps retaliatory measures that could be forthcoming from our trading partners. So that's really where I think the divide in the market is, and you're seeing the stasis in the market because there's really no clarity on what could potentially happen even after tomorrow. So tomorrow we'll get some clarity on what the Trump administration is going to do, but really a lot depends on how our trading partners respond to the tariffs.
So when you take a look then at the 10-year yield and your call for it moving lower, I'm struck between the safe haven demand for treasuries, but then also the inflation premium that needs to be baked in. How do you square those two?
So if you look at inflation expectations, I'd say for the most part, the market is thinking that it's going to be sort of a short-term rise in inflation. So you're seeing two-year break-evens, for instance, start to price in higher inflation expectations. But 10-year break-evens, for the most part, or longer-dated inflation expectations have remained, at least market-based measures of inflation have remained relatively contained. Where you're seeing that concern being borne out is in the survey-based measures of inflation. You look at the Michigan survey, 5 to 10-year inflation expectations are actually, the highest they've been in a couple of decades. So for the most part, I think that inflation could be somewhat, say 1 or 2 years out, you could see some inflation, rise. But over the longer run, the market's not really looking at higher inflation expectations.
Which then begs the question, if we wind up having, say, a 10-year that has a range but anchored, is the action really in the 2-year as we weigh, say, inflation versus growth?
Yeah, I think the front end is going to be pegged to policy. 2-year break-evens have risen quite meaningfully. But what we're going to really need to see is the potential feed-through to get a better sense of how long inflation is going to be persistent. But really what I'm really focused on for the long end is the impact on growth. The longer the Fed keeps policy on hold, the higher inflation remains sticky. I think you're going to see that translate into lower growth. And that's really the concern that the market is starting to price in is if we could potentially see a recession. We're not seeing that in the hard data. The hard data has been relatively strong. It's really the sentiment indicators that are starting to really show a souring of sentiment, if you will.
Well, then that brings us back, I think, kind of to the original question that Alex posed at the start of the show, which is how much safety, if you will, do U.S. Treasuries, U.S. fixed income overall, offer at this point?
So I think that the Treasuries or Treasury market is going to be the safe haven asset. If you look at an environment where you see perhaps more pressure on risky assets, then I think that investors will migrate away from risky assets into treasuries. And that negative correlation between treasuries and equities, for instance, will be back in place. So I see a scenario where if we do see a persistent decline in equities, investors are going to very quickly pivot to the safety of treasuries. I mean, yes, there's a concern about debt and deficits, and I think that that's something that we should be thinking about. But I think that's more of a second half story as opposed to a first half story.
Yeah, or, given history, that could be like, the story like 20 years from now. I am curious, though, about competition from overseas. I mean, when we talk about the safety trade, we have seen a lot of people piling into the yen. We've even seen some people piling into European debt on a relative basis. Is there an argument to be made that some of those areas outside of the U.S. might actually offer more protection?
So we have kind of, at least in the last few weeks, seen a meaningful decoupling between treasury yields and bond yields. Bond yields are actually rising because of the fact that there's an expectation that Europe is going to issue a lot more debt. And, in fact, we have our European strategists expect 10-year bond yields to rise to 3.3% by the end of the year. So, in a similar fashion, you look at JGB yields, it's the same story there. Domestic buyers are buying or investing more in JGBs as opposed to in 10-year treasuries. So you're seeing that, this decoupling between treasuries and bonds as well as treasuries and JGBs. And that's where we have a little bit of an out of consensus call. We're expecting 10-year treasury versus bond spread to actually narrow to 45 basis points by the end of the year. So we'll have to see if that actually comes to play.
All right, Subadra, always an illuminating conversation. Subadra Rajappa, head of U.S. rate strategy at SocGen, as we await, of course, the big announcement from the White House scheduled for 4 p.m. Washington time tomorrow. Those retaliatory or reciprocal tariffs, if you will. We're now learning, crossing the Bloomberg terminal, that the leaders of Canada and Mexico have held a phone call to discuss what they might do next. Meanwhile, here on this program, we'll discuss the impact on the economy with a readout of the latest manufacturing data from the ISM. A conversation up ahead with Tim Fiore. Stick with us.
All right, plus a turbulent quarter for airline stocks could continue through the year. A new note out from Jefferies downgrading several names, why macro uncertainty and tariffs could deepen that sector slump.
And tariff turbulence not just affecting airlines, it's also potentially affecting the home construction industry. We're going to talk to Tarek El Moussa, of course, the home flipping expert and the star on HGTV. He's going to talk about his latest ventures and, well, how he's coping with the potential increase in the price of lumber and other building supplies. All that and more coming up here on The Close. This is Bloomberg.
The Institute for Supply Management's manufacturing index fell in March for the first time this year and showed prices rising for a second month. It was a trigger that started the volatility in the stock market. Joining us now to discuss is Tim Fiore, the man behind the number, chair of the ISM Manufacturing Business Survey Committee. Tim, what is my big takeaway from the numbers this morning?
Well, I think let's pick up on what Subadra said about sentiment. We did a total reversal since January. In January, we were a 2-to-1 positive sentiment. In March, we're 1-to-2. So in the space of 2 months, with announced tariffs looming, back in January, they got deployed on steel and aluminum sometime in early March. We saw the impact of this. We've had 5 measurement periods since the new administration went in place, and we saw real positive moves in November, December, and January somewhat, and now we're back to where we were back in October. So, one of the most quoted things that came through my report this month was, we're not sure what to do. So hopefully this week is going to give us some amount of clarity on that. I think it will. We probably won't have all the clarity, but to kind of put it in its perspective here, the inputs are really supporting the PMI number being at 49. If you normalize those inputs, i.e. the manufacturing inventory number, and put it into something more normal without the pull ahead, we're probably sitting here at a 48, 48.3. So that's not catastrophic, but keep in mind, we've been talking now for years. We spent 28 months depleting our order book. And we were hoping that the new order level, positive new order level, would start to rebuild that order book. We have not rebuilt that order book. So in the absence of new orders, there's only one thing that we can really do, and that's to release people. So the real news for the month here is that our production was down this month for the first time in several months, surprisingly so.
Yeah.
And along with that, our employment number is down too. So that's concerning for the future.
Yeah, the employment contracting fastest pace in September to that point. Hey, Tim, how much of this is in reaction to tariffs that have gone into effect versus future tariffs?
Well, we know last month was tariffs that were going to go into effect. None of this should have anything to do with tariffs that are going to go into effect unless the market has already priced that in. So for instance, with commodities, what happens when you announce a tariff deployment, the commodities immediately rise to that price. We've seen a 25% growth in steel and aluminum spot market prices since the end of January. And the steel and aluminum tariffs didn't go into place until I think it was late February or early March. So the closer you get to a near commodity, the closer you see that impact right away. And you know what's going to happen here, like in the automotive side. If we put 25% tariffs on imports, the domestic producers are going to raise their prices because they don't want a 25% benefit to beat their competition. They're going to close that gap somewhat. So we're looking at price growth coming here for an extended period of time. I'm not calling that inflation, but when you see a general growth in what you've got to buy every month, eventually you start arguing about higher wages.
Yeah.
And that's probably the biggest issue that we're looking at for the second half.
In terms of the short term and maybe a potential bridge to maybe some resolution if you are an optimistic person, what did that increase in inventories in the most recent month? What did that say? What was that telling us?
So it was a confirmation that there was a pull forward, that people felt that maybe this really was a bluff. Therefore, if we can pull forward material that was planned for future deliveries, then we might be able to avoid the whole tariff war. Most people can't pull forward more than a quarter's worth of goods. That's a significant pull forward. So let's make the assumption here that that's what we got. We had companies pulling forward materials. They got a quarter's worth of goods. It's now becoming very clear that these tariffs are not bluffs. that they are not going away. This is all part of the budget reconciliation activity that's going to occur this year. I think that the speaker has said it probably won't happen until April or May. So these tariffs are not going to go away. I would guess they're not going to go away, possibly not this year. And because you can't use them and then claim reconciliation, then take them away. So we're probably looking at a long-term impact here. And that may be good, it may be bad. The good thing is, if it is long-term, then we can go ahead and clear the decks, make investments, move forward. If we don't think it's long-term, you're still going to see the manufacturing community frozen because they're afraid they're going to be lifted, making the investments in the wrong place, da-da-da. So I think that's kind of it, Romaine, is that most of this is about, okay, I'm already experiencing it, and I hate to see what's coming.
Yeah, and I think we've, at least anecdotally, seen a lot of evidence here of a lot of companies and industries in paralysis right now, just trying to wait for some of that smoke to clear. Tim, we have to leave it there. Tim Fiore is the chair of the ISM Manufacturing Business Survey Committee. Those numbers came out this morning, and it pretty much showed what we all expected here. A lot of companies out there tightening their belts, maybe pulling back on hiring. And of course, as far as output, not a whole lot going on right now.
Is this stagflation? Is this what stagflation looks like in the manufacturing sector?
Yeah, the manufacturing sector, and we should point out the manufacturing, of course, is the smallest of the major sectors in our economy. It'll be interesting to see what the spillover is into the more
like services, for example.
Services sectors. Thank you.
Yeah.
Much. Yeah.
And we'll see for the jobs report also, right? Like, it's just manufacturing, but if that trickles down, then we see issues.
Yeah, and when we talk about services, a lot of that has to do with consumer discretionary spend on things like travel and leisure. We're going to talk about that when we come back. A lot of turbulence out there for the airline stocks. Jefferies actually downgrading several airlines on both the U.S. and Canadian side of the border. A conversation up ahead in our top calls. This is Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations. We start with Kroger. The grocery store chain downgraded to sell at Milius. The analyst trimming her price target to $58, saying Kroger is losing market share to Walmart, which has created significant price gaps with those conventional grocers like Kroger. The analyst also adds that the lack of a permanent CEO not helping matters. Nevertheless, Kroger, believe it or not, up fractionally on the day to a record high. Up next, another downgrade to sell, this time for Genuine Parts. This is the automotive and industrial parts distributor. Goldman saying that the company is less protected from the tariff uncertainty than its competitors, O'Reilly and AutoZone. Those shares down 1% on the day. And finally, Air Canada. Jefferies downgrading to underperform, lowering the price target to 12 Canadian dollars from 18. The analyst cites tariffs weighing on business confidence. She also downgrades U.S. carriers Southwest, Delta, and American, but leaves United as her only buy-rated airline. Shares of Air Canada bucking the trend up 0.6%, and those are some of our top calls. But we stay on that last one with a closer look at air travel and the impact of tariffs on that industry. Sheila Kahyaoglu joining us right now, Managing Director and Senior Aerospace and Defense and Airlines Equity Research Analyst at Jefferies.
Sorry, so
had
long.
to get it all out.
Such a big title.
The benefit of covering both sectors.
Well, you're the best person to talk to on this day. I am curious. I mean, we've already gotten a couple of warnings out of the airline saying don't expect a repeat of 2024 in 2025. Your downgrade today is focused on their pricing power or drop in passenger volumes? What?
A little bit of both. So what we got mid-March out of the airlines was cutting Q1 guidance. They didn't really touch the full year because oil going down saved them. What we're making a call on today is Q2 EPS is about 45% of EPS. Q3 is maybe 35%. So you have the two big quarters coming up, and 50% of airfares are not yet booked. So the market instability, tariffs, et cetera, are going to weigh on the consumer. Everything is getting more expensive, and that might impact estimates. Our base case for the year is flat domestic pricing. Every 1 point of domestic price is 12% to EPS reductions for the four major carriers.
I know you have to look further out. We should point out that a lot of the tariffs are not actually in effect yet. We don't even know what some of them are going to be. Do you think the companies themselves and CEOs, when we get to earnings season in the next, 2.5, 3 weeks or so, do you think they'll be able to articulate a forecast for the rest of the year?
Delta will report on Wednesday, April 9th. So pretty early on, given they don't know what their bookings will look like for the second quarter, which again is 45% of EPS essentially. So I don't think we'll get an answer. And out of our aerospace supply chain, we're seeing a lot of mixed messages. And aerospace is so long cycle, they're not going to see it. So they might not hit the carriers until 2026.
Is this domestic or international that is going to struggle the most?
So on our airline call, downgrading the sector essentially is a domestic call. We're not even touching international yet. We're assuming international stays intact, up 2%, people still come to the US, et cetera. And then Atlantic, which has been the strongest region, don't forget all the benefits we saw last year, is up 3% on pricing. And we're seeing more capacity coming into that business too. Delta, United are increasing their flights 5 to 7% in Atlantic. So we're not seeing softness there yet. We're just saying the US consumer is not even negative, is just flat on the air.
We were just talking to Tim Fiore of the ISM manufacturing data. So I'm curious, it's discretionary for consumers, but what about for corporates and business travel? What are you seeing there?
I think, the airlines a few weeks ago cited a whole host of issues, whether it was DOGE territory impacting the federal employee layoffs, consumer weakening. They also cited a little bit of corporate demand. I don't think corporates are tightening their wallet yet, but I also think it's difficult to travel when the market is so volatile. How could you go out on that corporate trip? Even tomorrow, I'm set to travel tomorrow, and I'm like, I wish I wasn't, so I could stay and analyze the data as it comes out. So I think corporates might hold back traveling because there's so much market news coming out.
Which airline is probably more exposed to to a drop in corporate travel?
Delta and United have the most corporate exposure. However, our American downgrade was primarily based on corporate. Because they lost out on a bunch of corporate share last year, they have that fully coming back in 25, about 11 points of lost share. So they embed that fully improving. And so that's why we really cut them on their assumption.
Before we let you go, how are the small guys like a Southwest or JetBlue going to manage here?
Better customer service. I mean, I think.
Okay, that's a call. Redhead for Sheila.
I think it's really difficult. And Southwest also has one of the more aggressive assumptions. So unfortunately for them, we cut them. So airlines are down. We got some flack here for downgrading too late, but some of these stocks are still 100% buy rated. They're flat year over year. They're just down year to date.
Just real quickly, only have 30 seconds. Do you expect any sort of consolidation in the industry?
Again?
Perhaps, but I don't think it's necessarily helpful.
Oh, gotcha. Okay.
It's like, oh man. Okay, Sheila, thanks a lot. Really appreciate it. It was quite the downgrade. Sheila Kahyaoglu, Managing Director and Senior Aerospace and Defense and Airlines Equity Research Analyst from Jefferies, joining us there. From autos to cars, we're going to speak to Stephanie Valdez Streaty, Cox Automotive Industry Insights Director, about auto sales as we await President Trump's auto tariffs to take effect on Thursday. You recently bought a car, right?
Last summer. So we kind of, I guess, dodged a bullet, so to speak.
Glad you got that done now. All right, this is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. We're waiting for those Tesla sale numbers coming in tomorrow, right? That stock, the best performing stock on the S&P. But the other stocks, not so easy going when you have a lot of numbers coming in that raise big question marks as to auto tariffs and auto sales.
Yeah, and some of those numbers, I mean, they were actually impressive because we saw a surge in buying, particularly for a lot of the models that would be impacted by the tariffs. I saw David Welch had a great story about how the Chevy Trax, which is that kind of small SUV, sales were up 57%. That's made in South Korea. Some of their EVs, which are also assembled overseas, almost doubled in the most recent quarter as well.
Yep, GM, for example, to your point, deliveries up 17% in that first quarter. Also, Mercedes-Benz, apparently, did you see this?
Yes.
Is considering withdrawing its least expensive car from the U.S. market due to auto tariffs.
I believe it, because a lot of people are looking at these tariffs. And I don't know if you're familiar with the chicken tax, Alex Steele.
Okay, I don't know what that is. You don't even know what that is.
There was a chicken war back in the 1960s where Europe sort of banned, the imports of U.S. chickens, and we retaliated by blocking vehicles. And it basically led to what we now see along our roads, which are pickup trucks, SUVs, basically more expensive vehicles, and more importantly, vehicles that have wider profit margins. There was less incentive for the automakers to make those cheaper vehicles, and they moved to things that were a little bit more pricey and that would more friendly to the bottom line.
This is not the cheese tax that we were just told.
I don't know what the cheese tax is. I found out about that about 36 seconds ago.
Every time you open the fridge. This is not that.
Okay, is that affected by the tariffs?
I don't know. I mean, dairy, maybe. Anyway, so I guess the point is how much you can pay for your car, and you're going to get cheaper cars, or more expensive cars, I should say. Stephanie Valdez Streaty is Cox Automotive Industry Insights Director, joins us now. Stephanie, are we going to see that chicken tax, where we wind up having much more expensive cars because we're going to get all the cheaper ones off the road because there's no margin anymore?
Oh yeah, with this tax or tariff anxiety, we're going to have less production, which is going to be higher price, less sales. So it's definitely going to impact the industry. And unfortunately, a high percentage of the vehicles that are under 30 are really impacted by this. And so we've seen affordability a major issue the last few years. So this just really exasperates it. And so definitely it's going to have an impact. And we don't know, like the chicken tax, if this is going to be forever. But, according to Trump, these are permanent. So we won't know the impact. As time goes on, we'll have kind of more of how it's going to impact each OEM and how they pivot to really bring production to the U.S.
Well, to that point, can consumers adjust to the pricing, though? If prices wind up going up, how long typically does it take a consumer to manage that?
Oh, it's going to, I think right now, for consumers, I think if consumers are interested in buying a car now, they're out there buying it. And that's probably, we're going to continue to see like some sale upsurge in this month and maybe next month, similar to both ICE EVs. But I think for consumers, it's hard. They can only, buy now, but if they wait longer, those vehicles are going to get more expensive. And if the part tariff goes into effect also, that's going to also increase, maintenance, insurance, if they have an accident. So it has a multiple effect, right, these tariffs. And so I think from a consumer perspective, it's just going to be more cost.
Talk a little bit more about the parts side of this, because I have heard that a lot of the automakers, the auto industry is probably more concerned about the tariffs on parts, because that's sort of, forgive the pun, the moving part of that sort of industry.
Right.
And once you disrupt that, it's kind of game over. I mean, is there a capacity in our system, here domestically in the U.S., to increase capacity, output, of finished vehicles? And more importantly, is there enough warehousing and financing to stockpile some of those parts?
Yeah, I think the capacity, we have some capacity, but I think the big issue is it just takes long, right, to build these plants, to move production from, if it's from another country to the U.S. I live here in Georgia, and we have the Hyundai Kia mega plant that just had a huge announcement this past week. And it took them like 2 or 3 years, right, to still get up and running. And so it's going to take time. So these OEMs can't pivot that quickly. Mm-hmm. So I think in the short term, that's why we're going to see lower production, and it's going to impact prices and overall the new sales that we see in the marketplace. We're actually forecasting around 6.3 million in 2025, and now we're adjusting that to about 15.8 million. Because of the potential impact on sales volume.
That's a significant drop. And I am curious, Stephanie, when you look at what's already out there, meaning the inventory that we have on the lots, or at least here in the United States right now, I mean, how long would that inventory last? If hypothetically we didn't import anything for however many weeks or months, how long does that last?
That's a great question. And I think it's going to be dependent on the OEM. If you think of an OEM like Toyota, they have, fewer days supply than like a Porsche, BMW, GM. And so I think it's going to hit the OEMs differently. And you're right, once that supply runs out, then those new cars that are imported are going to have that tariff, and it's going to be, big increase for consumers wanting to buy that vehicle. And I think it's going to take time for them to adjust and build up production. And I think when you asked about the parts, I think when I think about EVs, it's even more significant if you think about the battery. Mm-hmm. China just dominates the entire supply chain for batteries. And so I think that could have a huge impact on EVs in addition to the 25% that is imported.
When you mentioned Hyundai and sort of ramping up its own production, how long it actually took, are there incentives that you hear from automakers that the government could provide that would help speed up these decisions and help the financing?
Yeah, you think about when the IRA was launched, that's exactly what it was. That was the goal of it, to really produce and build up a supply chain in the U.S. so that's resilient, sustainable, it's economical. And so there's things in process, but I think we need more of that for these facilities to get up and running quickly. It's going to take a lot of investment, as we just talked about, and time.
So definitely not there yet from that example. What's the lifespan of cars out on the road right now? I'm trying to get an idea of like when that replacement cycle is really going to have to kick in and people will be forced to like buy a new car.
Yeah, the average now is up to about 12 years. Wow. So you know what, but cars are being, well built. They're lasting longer, and so I can see consumers holding on to those cars longer, right? If we see an increase in tariffs on those cars.
Yeah.
And I think for consumers, if you have any maintenance issues right now, you should go to the dealership and get it checked out right now before we get implemented those part tax.
Well, I'm curious about that because when we talk about the longevity on the road, I mean, as someone who used to like collect old cars, I mean, I basically spent, every weekend of my life, at the AutoZone getting parts for those vehicles. So does that change the value proposition? I mean, yeah, hold on to your car. Maybe it's cheaper, but at some point, if those parts go up, maybe there's more incentive to buy.
Right. I think it's going to be kind of depending on what manufacturer, what model that you're considering. And if it has more production in the US, it's going to be less. And so I think that's going to kind of be the decision point.
Yeah.
And I'm thinking about EVs, right? Even for parts for EVs, because it's so new, right? And there's not economies of scale yet. So when you have your EV that needs maintenance, those parts aren't as prevalent in the marketplace, and so it's even costlier for that. So I think that's another impact from EVs. The whole parts could have a bigger impact as well, especially on aluminum. EVs tend to have more aluminum to really reduce the weight.
Yeah, absolutely. All right, Stephanie, great stuff. Stephanie Valdez Streaty over at Cox Automotive, a closer look at the automotive sector, which is potentially going to be hit the hardest, Alex, by these tariffs. And if you want some advice, Alex,
please, always.
Don't ever collect old cars. It's like buying a boat or an airplane or something.
I would never ever do that, but I do admire when you drive in the country and you see everyone that has all their old cars. It's super cool.
You're better off just taking $100,000 out of your bank account and setting it on fire.
Is this that's specific feelings about that? Did you have a trauma from this in your past?
Let's say I don't have those cars anymore. All right, coming up here on the program, we're going to actually talk about some of the stocks that are moving higher, and that includes Roblox, the video game platform announcing a partnership with Google, and it looks to build up its revenue from advertising. Those shares on fire. It's our stock of the hour that's coming up next, right here on The Close on Bloomberg. Time now for our stock of the hour. Watching shares of Roblox on an intraday basis. Best day in 4 months. Alphabet also moving as well. This on the news that Roblox is partnering with Google to offer ads that encourage player engagement. Now, this is a big step for the video game company as it really seeks to make more revenue from its advertising efforts. Mandeep Singh covers the sector for us as a senior tech analyst at Bloomberg Intelligence. All right, so in a nutshell, explain to me how this has worked. So if I'm playing a game, does the ad come on? Or is it when I first log into Roblox it comes on? Where does this ad show up?
Yeah, it's more of a 30-second ad that they're going to show you while playing the game. And it's no different from consuming TikTok content or YouTube content. So it is a video ad, full screen that you're seeing. Hopefully it's targeted so that you're not surprised by, the ad totally disconnecting you from the game, but that's the intent.
Or that it's okay for my daughter who's 10, who's playing Roblox, to get the right ad. So what are the terms of the partnership as we know it, and what's the kind of upside that Roblox could get?
I mean, look, a platform like Roblox has got 70 billion hours consumed in a day. That's how much time spent.
70 billion?
70 billion.
Oh
And just to put it in context, YouTube is more like 900 billion hours or even more. So it's give or take, 10% of YouTube hours. But the fact is they are not monetizing that engagement the way YouTube or Netflix is. And that's where, launching ads makes a lot of sense. And I think it's a good thing that they're partnering with Google as opposed to going on their own, because we've seen Netflix and Hulu really challenged by ad monetization. They haven't really figured that out. So I think it's a smart thing that they are partnering with Google.
Well, I hope they do a little bit better than with YouTube, because I feel like some of the ads on YouTube become a little intrusive to the point where it's like, okay, let me finish watching, the music video or the speech before you.
Advertisers like that.
I know. But to this point, who needs this more? Is it Roblox or is it Google? Because there's been a lot of talk about Google's traditional internet search business, whether it's under the threat of AI or even just the fact that a lot of us, as you point out, aren't really on those platforms. We are on Roblox or Discord, a lot of other, non-traditional platforms consuming our media and our search.
I mean, for Google, it's just about building their ecosystem. And look, they still have the search business. That is the cash cow. Everything else pales in comparison to that.
Yeah.
But still, I think they want to encourage enterprises use their cloud. use their advertising stack. And that's the playbook now, is to really be more like Microsoft in terms of engaging with different companies. And I think that's what they're trying to do here.
So taking a look at Roblox real quick. So we're at 61, off from those highs that we saw just a few months ago at 74. What do you think gets us to new highs here for Roblox?
I mean, for a company like Roblox, it's about free cash flow growth. And the disconnect so far was their bookings growth is always higher than revenue growth because people buy the virtual currency, but it takes a while. There is a lag between buying currency and spending it on the platform. Advertising is all revenue. So and it's all free cash flow. So from that perspective, also, you will see a bump in free cash flow if the ads take off.
So it could be material. All right, Mandeep, thanks a lot. Always a pleasure. Mandeep Singh of Bloomberg Intelligence joining us there on Roblox. We're 15 minutes to the close of trading. If you look at the intraday chart of the S&P, it's been kind of a wild ride. We just couldn't seem to make up the direction, crossing that neutral line 3 times so far. So a lot could happen in the last 15 minutes. We're going to take you to the closing bell with Mandy Xu, head of derivatives market intelligence over at CBOE, as we head into Tariff Wednesday. This is the close on Bloomberg.
I would say that the market's very divided between, some of the participants thinking this is an opening salvo for a negotiated deal. And then on the other end of the spectrum, you have investors who are concerned about 20% tariffs across the board in all the countries. So that's really where I think the divide in the market is. And you're seeing the stasis in the market because there's really no clarity on what could potentially happen even after tomorrow.
And you're seeing that divide in the market in a big way, with about half the S&P stocks up, half down. Subadra Rajappa kicking us off to the close 50 minutes ago, Alex. And this is a market still searching for direction. We were down, we were up, and it looks like heading into the close, a modest bid coming back into the main benchmark.
Yeah, it feels like there's not a lot of necessary position being taken on. It's clearly, though, shocker, led by tech. You have the NASDAQ up by 0.7%, the Mag 7 really outperforming, but the Russell pretty much flat, down 0.1%. So nothing crazy, but you have to wonder who's taking on big positions to the up or downside headed into tomorrow.
Mandy Xu joins us right now, head of derivatives market intelligence over at the CBOE. And Mandy, I mean, the question right now is, when I look at all the volatility, I look at all this price action, I assume everybody right now in the derivatives and options market is just preparing for Liberation Day tomorrow. Is that the case?
So what's actually interesting is if you look at the volatility curve, there's not a huge amount of premium been priced in for tomorrow. And I think that's because investors have come to the realization that tariffs are not a one-time event, right? They are very much a ever-present risk with the Trump administration. So whatever happens tomorrow, yes, it is meaningful, but let's not kid ourselves. Could we get a change in policy, change in tariff rates, a week, a month, a year from now? Certainly. I think that's why not only is there not a substantial premium for tomorrow, if you look at the vol curve, it's remarkably flat. So 1 year S&P vol trading at parity with 1 month, that tells you people are expecting volatility to persist. Are people hedging to the downside in a meaningful way? Not a meaningful way, I would say. Coming into this quarter, this year, we were seeing a pickup in volatility, and I think most of the sell-off over the past month, actually quite a bit of monetization of hedges. So not a ton, but at the same time, I think people are looking at rotating out of equities into potentially fixed income and other asset classes and other regional equity benchmarks as well.
You talk about the curve being relatively flat, but if you look at, say, where we were about a year ago, I mean, there was a range, definitely from 14 to 18, right? And now it feels like you look at the whole curve, it's re-rated up to over 20. So what's that new range for the VIX?
So what's interesting, so absolutely, we re-rated higher. We're in a higher range. But if you look at the volatility, so if you look at the VVIX index, over the past month, it's actually fallen even as the VIX has increased. And that tells you investors are actually expecting the VIX to stay in this range. So there's not a ton of that bid for those very out-of-the-money calls, not really expecting volatility to fall either. So really kind of playing for this range-bound volatility environment.
That's so interesting. Is it the same for individual companies or sectors?
So not quite. So I would say at the sector and the individual stock level, what we've seen over the past, say, quarter is that there's actually more of a focus on macro risk, a shift away from stock-specific risk in the market. So if you look at single stock volatility relative to the VIX, that spread has actually narrowed. And that's something that we've been highlighting for a while now, that initially most investors were treating tariffs more as a stock-specific or sector-specific driver, which is why you saw so much volatility at the stock level. But we were kind of warning that actually tariffs could be a macro risk if it really impacts economic growth. And you're really seeing that shift now where you're seeing higher levels of correlation in the market and kind of that spread between single stock volatility relative to the VIX starting to narrow.
Those correlations, you're talking about within the indexes themselves or across asset classes?
So both are shifting. So within the index levels, within the S&P, we're seeing correlations tick higher. That's typically a sign of more macro risk being priced in. And then across asset classes, one of the things that we've been highlighting is that equity bond correlation is really starting to shift and really starting to turn very positive. Yeah.
One thing we were asking Subadra at the top of the show was about, for those folks who are looking for protection hedges or whatever you want to call it, what is kind of the more effective way to do that in this environment?
So traditionally, I think people have turned to fixed income as a diversifier to equity risk, right? And that's one of the key reasons to hold fixed income in a portfolio. What we've seen, and this is not a recent phenomenon, but over the past 2-3 years, more and more people are actually turning to options for that as a way to reduce portfolio risk. So allocation to option strategies, and whether that's through ETFs, mutual funds, whether it's different wrappers, we've seen a huge growth in that space.
When you take a look at the risks that are coming up tomorrow, you have Jobs Friday, we have earnings season. What are we preparing for the biggest risk when it comes to, say, the volatility?
To me, I think that the biggest question is going to be the economic outlook. And
so it's more of a Friday event.
To me, the Friday, the payrolls, CPI, those numbers are much more important than any potential tariff announcements that are coming. Not to say that tariff announcements are not important, but to my initial point, you just don't know how long it's going to actually stick around for and whether that's going to change down the line.
What's cheap right now? Like, where is it cheap to buy protection or upside? Like, is there anywhere?
If you're looking at volatility, I would say kind of volatility is pretty expensive across the board. The one asset class we're really highlighting where volatility maybe hasn't increased as much, and that's interesting, is credit. So if you look at VIX IG, which is our indicator for volatility in the investment grade credit market, that's gone up over the past month, but it's still trading around kind of the long-term historical average. Whereas if you look in the bond market and in the equity market, volatility is significantly above the historical average.
I know we don't know exactly what the president is going to say tomorrow. That announcement is supposed to come at 4 p.m. tomorrow from the White House. Is that going to be a tradable event?
I think I think what you're seeing today is people are in a holding pattern to really see what comes out of that event. I think, with the Trump administration, they're very unfortunately. So I'm not sure a lot of people are going to be front running that announcement necessarily, but more in a wait and hold pattern to see.
You haven't been invited to the White House for this,
no, unfortunately.
Okay, all right. All right, Mandy Xu, head of derivatives market intelligence over at CBOE. A closer look here at some of the price action in the market ahead of what could potentially maybe be a big day, at least certainly going to be a big day for President Trump. Whether it's going to be a big day for the markets, that's still TBD. I
mean, but you still get the calls, right? Like Ed Yardeni earlier cutting his call for the S&P for a second time in less than 3 weeks, right? You had David Kostin yesterday of Goldman doing the same as well, so that heightened recession risk. It just goes to show how quickly things are changing and how quickly things can be re-rated.
Although our stocks team wrote a great story today saying that even with that drop in expectations for end of the year, it's still higher from current levels. So they're still anticipating a bit of a rebound here. And I think that's really been the thing. I know that's what Trump is trying to sell people on, this idea that there's short-term pain, but longer term, maybe even the second half of the year, you get more of the positive policies that could potentially boost the economy and boost the markets.
Right, tax cuts. Maybe also we have any sort of bonus depreciation, right? That you can invest money and then that year you get a depreciation credit. Like, would that really help incentivize companies to build stuff in the U.S.? Like, that could maybe be an accelerator. So when we get those and the sequencing, really quite the question.
Yeah, and the question is, exactly. We don't know when that's going to happen. With an S&P up about 0.3%. This is not the barn burner of a rally. People nibbling around the edges, seeing significant weakness once again in some of the most exposed areas to tariffs. Meanwhile, big tech getting a bid, as are, some of the financial stocks, believe it or not. A full breakdown of everything that happened today, it starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele taking you through that closing bell. A global simulcast starts right now. Carol Massar and Tim Stenovic join us from the radio booth. Scarlet Fu is off today. We welcome all of our audiences across all of our platforms, including our partnership with YouTube. We're 2 minutes, Carol Massar, from the closing bell, but we're 24 hours from a big announcement out of the White House.
I know. I don't know how many times you said tariffs today, but we said it a lot. So we are anticipating that certainly from the White House. You know, the devil's in the details. He's supposed to be meeting the president this afternoon to talk with his advisors to work out the specifics. So who knows what we might get at just about 24 hours from now.
I mean, equity traders are trying to figure it out with today's moves. The S&P 500 is searching for direction. I think everybody's just waiting to see what happens tomorrow. Why do you guys think he changed the time from 3 o'clock to 4 o'clock? Do you think
because markets are closed?
That's what I'm wondering.
Yeah.
Yeah, I don't know.
Well, because then you have time to digest it before there's any massive stock movements, which raises the question, will tomorrow be a tradable bounce? Will it be a clearing event or a springboard? And how do you position for something like that?
Yeah, we were just talking to Mandy Xu over at CBOE. She seemed to think maybe not. And based on the price action she's seen in the derivatives and the options markets right now, not a lot of people, at least in that space, are positioning around the announcement tomorrow. But we have to also kind of remind ourselves, we have had a major sell-off over the last few weeks. So maybe that was the pricing in of that risk.
Yeah, you do wonder, right? Oh, sorry.
No, you go.
No, you go.
Oh, okay.
Wow, how sweet is that?
I was just saying, S&P, worst quarter since September 2022. So maybe a little bounce to be expected.
Yeah, a lot to talk about tomorrow, including that chicken tax and that cheese stack. But today we talk about the markets. The markets searching for direction and a mixed bag that we get the closing bells here in New York. It takes a while for these numbers to settle, but it looks like the Dow Jones Industrial Average is going to close the day unchanged. Right now it's down about 15 points, but again, those numbers can change just a little bit over the next few seconds or so. The S&P is going to finish in the green, up about 21 points or 0.4%. The NASDAQ Composite up about 150 points or 0.9%. Similar move higher for the NASDAQ 100. The Russell 2000 flat on the day. We'll just call that unchanged, though you did see a little bit more of a bid into transports as well as into S&P 400 mid caps.
All right, to the S&P 500 I go. Not quite an even split. A little bit more to the upside. 298 names actually gaining ground on this April Fool's Day. 204 to the downside, Alex, and one unchanged.
All right, taking a look at the IMAP here, the function that looks at different sectors in the red and the green. It's all tech, guys. At the end of the day, you have consumer discretionary, communication services, all outperforming, up by about 1% as well as tech. The downside, though, guys, healthcare. So maybe kind of the safety trade, also healthcare getting weighed down from that Cantor note from yesterday as well. And financials pretty much flat there on the day, Carol.
All right, let's get to some of the individual gainers. I had to talk about Newsmax. I know, again, a bunch of volatility in the trade. Trading stopped because of some of the moves. But you're looking at another day where it just soared 179% to the upside. That's after gaining 735%. We talked about throughout the day that you're looking at, a two-day gain of more than 2,000% at one point. Market cap going to, I just need to check, I think it was at $18 billion. So it's kind of interesting. I guess we'll have to wait to see until in terms of earnings when that finally comes out in mid-May to kind of get a feel of the business.
$18 billion?
I know.
Can I just put that in perspective?
Oh, no.
Please.
Warner Brothers.
It's $29 billion.
Okay.
It was 18 earlier in the day.
Let me put that in perspective.
Please.
Warner Brothers Discovery, a much more sprawling media organization, has a market cap of about $26 billion.
I know.
Are you saying it's detached from fundamentals, Romaine?
I'm not saying anything, Tim.
He's just pointing out the facts. He is pointing out the facts of market caps.
Data-driven news organization here.
Bailey Lipschultz's story says it's solidified its status as a meme stock. So
2,000% pop in 24
Feels
hours,
memey
36
to me,
hours. Yeah, sure.
Yeah, and it blows away some of the, if you look at something like price to sales, some of the peak metrics from GameStop or AMC. So it's I had to mention. See, look at all that we talked about. PVH also among the individual gainers today, up about 18%. We broke it down yesterday. If Romaine opens up his closet, if Tim opens up his closet, it's all Calvin Klein and Tommy Hilfiger.
What? No, that is so lowbrow for Romaine. Crazy. Have you not seen what he wears?
Oh, gosh.
I know, he's
Putting
so
me on
dapper.
blast.
He's so dapper. I think he wakes up looking like that. Don't you think
I
so?
do. I sleep in
He
this
does.
suit.
He
100%
promises
agree
he's
with
going to
that.
teach me how to tie a bow tie, but it hasn't happened yet.
Keep waiting. Anyway, the company gave a guidance for 2026 adjusted earnings that beat the average analyst estimate. And then, guys, I had to go to Tesla because this one, at one point during the day, was the top gainer in both the S&P 500, the NASDAQ 100, finishing the day with a gain of about 3.6%. And this is despite sales falling almost 40% in France last month. We continue to see bad sales numbers, especially when it comes to Europe. I don't know. So there we go. Still down more than 30% year to date. But again, this was an outperformer among the Mag 7 today.
Can I just add an honorable mention on there? CoreWeave. Did you see what that did today?
I did. Oh, I
42% rally today. Now at $52. Remember, it had a pretty middling debut on Friday. Sold at 40, opened at 39, closed at 40. It was down yesterday. And today, for some reason, a 42% pop.
Why? Do you not know?
I don't know. I just bring you the facts.
He knows everything.
I'll let you guys do some research while I do my decliners
what do you
here.
think, Tim?
I'm looking at shares of Johnson & Johnson. They had their worst day going back to 2018. This after the company's plan to settle thousands of those talc-related lawsuits through bankruptcy was actually rejected in court. Shares fell 7.6%. So this means that the company will have to fight about 60,000 claims in courts across the country. Also, shares of Delta Airlines, and really a lot of airlines taking a hit today. Delta fell by 2.7%. Jefferies cut Delta to underperform from hold. Uncertainty around consumer and corporate spending. Sheila Kahyaoglu over at Jefferies expects American, Air Canada, Southwest must cut their annual forecasts. And then she says Delta is likely to cut its annual forecast. Once again, shares down by about 2.7%. I'm also watching ADRs of Xiaomi. They fell after the company confirmed that one of its SU7 EVs was involved in an accident on an expressway in China that resulted in 3 deaths. Shares fell 5.8% today. The accident sparked concerns over the safety of Xiaomi's smart driving software, and it could impact the company's competitiveness and growth outlook, particularly in its EV business. Once again, ADR is down by 5.8%.
All right, guys, if you want to go get some safety, you go to the bond market, and we saw that in full display today, particularly on the back end. At one point, you would yields down as much as 10 basis points, but they closed up by about 4 basis points lower, 4. Oh, my God.
I have no idea what she's trying to say.
Alex,
4.16.
3, 2, 1, go.
I did it. There we go. This happens when I talk too fast. All right. Anyway, point is that there's a bid into the bond market, mostly the back end. My question is, though, if we see more inflation kick up, when does the bond market then become less appealing as a safe haven, because then you're factoring in the inflation, but those break-evens are still relatively well behaved?
Yeah, and it's kind of interesting, too. I mean, when you look at this, I mean, this does not scream panic. Yes, some people are flocking to the bond market, some people in options, but as Mandy Xu just said, you're not really seeing a wholesale positioning for, I guess, deep risk, if you will. And you brought up just a little bit a while ago there, Tim, the downgrade that we saw over at Jefferies, and we were speaking with Sheila as well. You know, this is about what the airlines can now do to maybe potentially mitigate a potential drop in passenger traffic. Like, what can they do to bring people into the airports and onto those planes?
Does it have to do with hamburgers?
Nice.
You know you were doing that?
Yes.
That was very slick, actually.
Yeah.
Maybe they could do that. Okay, so one of the most read stories today is from our Bloomberg Business Week team, Brooke Sutherland and Mary Schlangenstein. They're talking about the first class perk on some Delta routes includes Shake Shack burgers. No, not fries yet. They haven't figured out how to do fries. But apparently...
I have thoughts on this.
Okay, what are your thoughts?
Let me just preface this, say I love Shake Shack.
Okay.
Is that a first-class meal?
Yes.
Have you been on an airplane in the U.S. in the past few years?
No hesitation by Alex.
I mean, or would you prefer the really gross couscous with the salmon on top that just was microwaved?
Yeah.
Ouch.
It does beat some of the in-flight options that I have eaten in recent years. I will say that.
Okay. Well, you got to fudge it a little bit. Just, tell them you're kosher or halal or something. You get a little bit.
What's your meal of choice, Raymond?
I'll just lie, Tim.
I'm just saying.
I don't know. Honestly, I take what I can get these days on airlines. I just keep my mouth shut because I don't want to get thrown off or something.
We did speak to Mary a little bit about this, and I think it's fair to say, like with the big 3 airlines, American, Delta, and United, when it comes to that first class hard product, right, they're very similar. So if this is a way to differentiate, see what United and American have to do.
Yeah, no, I agree. Absolutely. I mean, you have to try something to kind of stand out from the crowd, and maybe this gets it there. Another interesting story that I came across this morning, and I was kind of confused by. Did you know people are flocking back to Tumblr?
I thought this.
So 2 questions. A, I didn't know Tumblr was still going.
Down?
And 2, I don't know. Apparently it's still going, but apparently a lot of younger people are kind of fed up with a lot of the social media platforms out there. They say they just don't really offer the engagement. And they're finding it back on Tumblr. It's like everything old is new again.
Love it when we talk about young people as if we know what's going on.
Hello, fellow kids.
There's a line in this story by Business Insider that says part of the reason young people are hanging out on an old social platforms is that there's nowhere new to go. How about going outside and doing something?
Now you sound old. Who's old now, Carol?
Get off my lawn.
All these kids just in the house all day.
But doesn't this also go to the whole point of like Meta was trying to get back to like the OG Facebook, where it was just friends and hanging out versus all the other recommended ads and stuff?
Going somewhere with someone.
Okay.
I don't like talking.
Not all of us have yachts that we can just
That's-
take off
it's
on
true.
into the wild blue yonder there, but you know.
All right. Q, we gotta go.
No, she's saying we can keep talking. We can stay.
All right, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. We will see you again, same time, same place tomorrow, guys.
The close continues and the countdown to those Trump tariff announcements also continues. Just about 24 hours from now, the president is set to walk into the Rose Garden and finally unveil what the market has been waiting on, an explanation of what U.S. tariffs will look like for the foreseeable future. Ed Mills, Washington policy analyst and managing director at Raymond James, joins us after the break. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Alex Steele.
And I'm Romaine Bostic. A lot has transpired over the last few hours. A trading session that once again was volatile, from gains to losses and back to gains again. The S&P finishing out the day higher, but only by about 0.4%. A similar story played out for most of the other major indices. A market right now, not just searching for direction, but quite frankly, searching for some clarity. Clarity on policy coming out of Washington. Clarity that some think we might get within the next 24 hours. Meanwhile, a lot of folks, a lot of investors are positioning for those worst case scenarios. The airline sector as a whole down for a sixth straight day, back to the lowest level since late last year. A big downgrade over at Jefferies because of a concern about a tamp down in travel. NASDAQ Biotech's down for a third straight day as a lot of concerns about policies with regards to the U.S. FDA and HHS. And take a look at your 10-year yield, relatively unchanged on the day, but maybe a reflection of risk sentiment.
All right, we'll take a look at the different individual stocks making some headlines. Romaine just mentioned it. So on the upside, you have Tesla up by 3.5%. Now, obviously, it was the worst quarter for Tesla going back since December of 2022. So you're naturally going to see some kind of rebound. We don't know yet about car sales, though, for the fourth quarter. We'll get that tomorrow. In France, it wasn't great. In March, in particular, sales for Tesla's fell about 37%. And Romaine, analysts expect that EV maker will sell about 390,000 cars in that first quarter. On the downside, Southwest Airlines down by about 6%, was the worst performing stock in the S&P for a while. Downgrade over at Jefferies. We spoke to Sheila Kahyaoglu, the analyst behind the call, basically saying that, look, they're all going to have to cut their estimates because consumers are just not going to want to spend and make big ticket purchases yet, Romaine.
Absolutely. And as we sort of watch the market action, all eyes will again turn to what's going on in Washington. Just 24 hours until the president is set to announce those reciprocal tariffs on U.S. trading partners. And the world is preparing for what's to come. The European Union warning of a, quote, strong plan if necessary, while Canada warns that they are ready to retaliate. Canadian Prime Minister Mark Carney also holding a call earlier today, a productive call, he said, with the Mexican President Claudia Sheinbaum on the trade relationship between the two countries. Ed Mills joins us right now. He's Washington policy analyst and managing director over at Raymond James. All right, Ed, I do want to sort of take somewhat of the attention off Trump for a second, because to a certain extent, we kind of know what we're going to get. We may not know all the details, but there is still the big elephant in the room of what the response would be from Europe, from Canada, from Mexico, maybe even China. Is there any sort of sense here as to not only are they willing to act, but how severe will that action be?
So, Romaine, I would fully expect them to act. I think that there is a shift in policy where the Trump administration had first anticipated that they could be so bold that everyone would be forced to come to the negotiating table to get these tariffs off. But what they're seeing is that world leaders don't know exactly what Donald Trump wants, and they're not quite sure if engaging with him helps them domestically Or once they negotiate, is Donald Trump going to move the goalpost again? And so we could absolutely see a response. And what I hear from my contacts here in D.C., Romaine, and what I'm telling clients at Raymond James is that Donald Trump will escalate if they do respond. He could use other authorities that have not been used before to say those policies of escalation are unreasonable, and he can put tariffs on up to 50%. So while we might get more details tomorrow, we're absolutely not getting more clarity.
Not more clarity. What's the activity like in Washington? And I've spoken with a few people, a few companies that have said they've been trying to have as much of a presence in Washington, whether it's in the White House or at some of the agencies like USTR, to try to make their case for what they want done. Are we seeing a lot of activity by companies and, for that matter, by some of these countries that will be the target of those tariffs?
Romaine, not as much activity as you would normally see for big policy fights. And this is what I've been telling folks at Raymond James, is that this is unlike anything else that I have to analyze. Normally, we see those fly-ins, we see those lobbying efforts, we have a draft bill, we'll have a committee markup, we will see the process evolve. But what's different here is that Trump and Trump alone gets to decide what tariffs he puts on, what tariffs he takes off, when he does it, how much it is. And so trying to figure out exactly what he's going to do is almost a fool's errand, because the only thing I know we're going to have over the next couple of days, months, weeks, maybe a year plus, is a roller coaster ride with tariffs. And I don't think these lobbying efforts near term help, because Donald Trump knows not to negotiate with himself in the first round as he puts this out.
I love the idea that you made, which is details versus clarity, and there is such a distinction there. Do you have a sense, though, of what mechanisms will be used and what sections will be used to implement tariffs?
Maybe. So in Canada, China, Mexico, he's been using emergency authorities under IEPA, the International Emergency Economic Powers Act. What we hear is under consideration is maybe using what's known as Section 122 authority, which is an uneven balance of power or of payments. That only lasts for 150 days. You could do that temporarily, but that only goes up to 15%, Alex. There is a conversation of maybe doing that on a temporary basis and having a longer term investigation known as a Section 301 investigation. And that doesn't have a limit as to how far the president could go. There's conversations of, well, does he break off the dirty 15 and do the emergency powers on that, and does a Section 301 or that 122 elsewhere? Or does he kind of surprise everyone and use that authority that exists from the 1930 Smoot-Hawley Act, which says if there's a country that has an unreasonable policy limiting the growth of the United States, the president, without an investigation, can go up to 50%. So he has a menu in front of him with lots of options that have lots of different timetables and lots of different legal risk.
Right, exactly. And then sort of and implementation timelines too, which then begs my next question. Do we know if these tariffs will be used for foreign policy, if they're going to be used to raise money, or if they're going to be used to incentivize production in the U.S.?
What if it's all of above?
You can't have them all at the same time.
Yeah, no, you can't. But I think so. When I've talked to folks that have worked for him and around and trying to figure this out, I think I put this into two buckets. One, revenue raisers. Two, policy changes. Those policy changes are going to take a little bit longer to be done. And it does kind of change foreign policy, change military policy, maybe open up markets for the United States, maybe incentivize companies to do more business in the United States. However, when I talk to those companies, they say, I don't want to make a huge commitment on CapEx only to have this changed a week from now, a month from now. So businesses don't really know. But there is a revenue component of this, Alex. And I think that this is part of a permission structure to put pressure on Congress to make permanent the 2017 tax changes. That could be the largest price tag of a bill ever passed in the history of the United States. If you're trying to get Republicans to do that, you have to show there's a new revenue stream coming in to get the votes necessary to pass it.
Right. That's such a good point. All right, Ed, thanks a lot. Really appreciate it. Don't envy your job. Ed Mills, Washington policy analyst and managing director over at Raymond James. All right, coming up, the race is on to buy new cars before Trump's auto tariffs take effect. We're going to talk to David Kelleher, president of David Auto Group, about what he's seeing at his dealerships. This is The Close on Bloomberg.
or tariff anxiety, we're going to have less production, which is going to be higher price, less sales. So it's definitely going to impact the industry. And unfortunately, a high percentage of the vehicles that are under 30 are really impacted by this. And so we've seen affordability a major issue the last few years. So this just really exasperates it.
That was Stephanie Valdez Streaty of Cox Automotive. For a firsthand perspective on this and what it means for all auto dealerships, I want to go to David Kelleher, president at David Auto Group, which sells car brands like Chrysler, Dodge, Jeep, and Ram. All right, over the last, say, 72 hours or in the lead up to that, what are people doing?
Well, we got an uptick in sales, and because people really don't know what's going on. And so they're coming in and buying cars that really won't be affected by the tariff. Or I think everything's going to be affected by the tariff because everybody gets some parts from overseas. So there's some components of the cars even assembled in the United States that are going to be subject to these tariffs. But our main ones are going to be the ones that come in from Canada and Mexico, and we have one car from Italy as well. So all of those are going to be impacted in a great way for Chrysler dealers, for Stellantis dealers. So there's a bit of a rush because the clients really just don't know what's going on and they're trying to beat it. Well, but the other thing they don't realize is we generally carry 60 to 90 days worth of cars on our lot, and all of those were not subject to tariffs.
Right.
So it won't be until the new shipments come, everything after midnight tomorrow, and then we're going to.
So David.
And then we're going to experience the tariffs.
So to that point, anything delivered to you after midnight tomorrow, how much more expensive do you think those cars are going to be?
Well, candidly, if you read the rule the way it is, and nobody quite understands exactly what's going on because we haven't gotten the details. And I speak to executives at Stellantis all the time, and they don't really know what's going on. But if you take it as simply as put, if I have an $80,000 Ram coming from Mexico, it would be $100,000, right? I mean, the math is simple. It's just that simple. I think it would be discounted by any American parts that went into it, but the math is just that simple. So when people talk about $6,000 to $10,000, maybe that's an aggregate, but it's going to be a substantial increase for the consumer.
Yeah, and I am curious too. I mean, we kind of came into this year with prices, at least those MSRPs, relatively elevated. And at the same time, you had interest rates elevated. So for those folks that needed to finance, the value proposition, at least compared to a couple of years ago, was way different.
Well, it really is. I mean, I'm seeing customers that came in 3 years ago, they leased a car for $369. And now we say, good news, the same car is $575. And they're already taken back by that. So then you throw a tariff on top of it, and the effect of that, and it's really just discerning because the manufacturers have really reached out to try to. Again, you had an interest rate increase, you had the giant price increases during the pandemic that they're trying to resolve right now, and then you throw this into it, and it really shakes the market up.
Mm-hmm. I am curious, though, also about, in terms of running your dealerships, you also, of course, have service departments, and there's been a lot of talk that it's not so much just the import of cars itself that is going to have a big impact on the industry, but it's the parts, the supply chain. And I am curious that as you try to service vehicles and maintain that side of the business, which I was always understood was a more profitable side of the business, how are you anticipating your supply of parts to be able to fix those vehicles?
Well, I think in the short term, I think the manufacturers might take a wait and see. I think they're going to start holding, which is going to create back orders. I mean, I think they're going to wait and see if this thing cools off a little bit, and if somebody retracts some of the tariff. I'm not sure that I've spoken to Senator Moreno several times, and I'm not sure that that's going to happen. I think they're going forward with these tariffs. A customer coming in to repair in my shop is going to find an increase as well because these, a portion of our parts are shipped from overseas. Mm-hmm. We build engines in Mexico, we build engines in Canada. All these things were allowed by the previous administration, President Trump helped with the former NAFTA, in his last term. So, it's very difficult because this curveball is a big one, and it came at us pretty quickly.
All right, David, really appreciate your insights here. And we have to catch up with you in a few weeks once these tariffs do take effect and we start to see the potential impact. David Kelleher there, he's the president of the David Auto Group. Alex, there's so many industries, so many pockets that are going to be affected by this. It'll be just a matter of how severely the effect will be.
And when it actually hits, say, autos or pharma or retail, for example.
Yeah, and we're going to take a closer look at the lumber industry when we come back after the break. This is Bloomberg. Lumber prices have been back on the rise, climbing about 18% over the past 3 months. Concern about the ramp up in tariffs and the threats on that industry. Joining us now to discuss is Stinson Dean, co-founder and president of Revol Building Solutions, a manufacturing company that buys lumber to build trusses and wall panels for both residential and commercial builders. Stinson, great to see you once again. I think the last time we spoke was back in all the craziness in 2021 when we saw lumber prices at like $1,700 or so. We're nowhere near that at this point. But I am curious as to this increase that we've seen in prices over the last few months, whether you see that continuing. Is that going to continue to go higher?
The market's trying to price in potential tariffs. I do see it continuing on the back of uncertainty around tariffs. I don't think the fundamentals support current price trends, but it's all kind of tariff related at the moment. Where exactly are we getting our lumber? I mean, there's been a lot of talk about our dependence on Canada for at least certain types of lumber like softwood. When it comes to like building a home and other properties, where is most of that lumber coming from? I think 60% of U.S. consumption comes from Canada when we're talking about home building. So the majority comes from Canada. We've built with it for a long time. It's the preferred species of builders for a plethora of reasons. It's lighter, it takes a nail better, you can move quicker with it. So our whole industry is geared towards using Canadian lumber to build homes. And we should point out, I mean, there already is a tariff on Canadian lumber. What Trump is proposing would essentially increase that. And if you include the reciprocal tariffs, maybe even doubles that altogether here. I mean, without getting too deep into the politics, is there a sense here that if we just left the current tariff in place without actually raising it, that the industry would be able to manage that? Yeah, so there's a tax on lumber right now that goes back. It's a decades-long trade war. Lumber was carved out of NAFTA back in the day because there's a very specific dispute going back to the 80s. And right now it's near 34%. That's in place right now. So to add more on top of that, I think is going to be a mistake. You're going to shut down Canadian production. Right now we have a good balance. Those taxes that are in place have done their job. There's been an increase in consumption of domestic lumber, specifically southern yellow pine, and we have a pretty good balance. If you raise it even more, you're going to devastate Canadian production, and you're not going to have domestic production match the closures of mills. So the mill closures are going to happen way faster than we can offset it with domestic production. I am curious, Stinson, though, with regards to any additional capacity to produce more lumber. I mean, how much is out there? I mean, if we go down to the Carolinas or out to the Pacific Northwest, is there extra capacity out there that could compensate for any drop in imports that occur because of the tariffs? Theoretically, but we don't have the infrastructure. We don't have the sawmills. We don't have the labor to replace Canadian lumber today. And if the tariffs go into effect, those Canadian mills are just going to shut down way faster than we can retool and revamp and revitalize an industry, specifically up in the Pacific Northwest, which has a comparable species to what we buy from Canada, and can have the same use cases. So yes, we do, but we need to subsidize the ability for us to harvest that wood before we shut off the Canadian spigot. You also mentioned this idea of infrastructure, and I am curious as to what the state of the sawmill business is, because I was always under the impression that the only way you were going to profit off of a sawmill if you were basically running at like 99, 100% capacity. Yeah, it's not a great business. It's a very tough business to be a lumber producer. Volatility, they've had inflation issues with their input costs, both from logs and labor. So that break-even price has gone up and up and up. So you got to have asset utilization rates that are maxed out as much as you can to squeeze a little bit of yield out.
Hey, Stinson, how's the new business going? I think the last time we talked to you, you were still trading over at Deacon. I see you got Revol up and running. Are you confident in your future right now, given some of the uncertainty out there about policy?
Yeah, so Revol Building Solutions, I've made a pivot into component manufacturing. So we're building roof trusses, floor trusses, and wall panels for mainly multifamily. So I'm risk on. We just closed this deal a few weeks ago. And, kind of bringing the trading and risk management into a manufacturing value-add process. So we're very confident. We're up in the upper Midwest and Northwest Indiana. These markets didn't get too hot, didn't get too cold. So there's a steady amount of business. If we were in the Sun Belt, I'd feel a little bit different about it. But the business is steady. It's not booming. And I think that has a lot to do with the location we're in.
Gotcha. Stinson, really appreciate you taking time for us. Stinson Dean, co-founder and president of Revol Building Solutions, with a focus on the tariffs and a focus on the home building sector. One guy who knows a lot about this joins us right now, a sector potentially impacted in a big way. Tarek El Moussa. He's the star of multiple HGTV shows, and it includes Flipping 101, and the new season of Flipping 101 premieres this Thursday. Tarek, great to have you.
Thank you.
Big fan of the show. And one thing I know, and your previous shows as well, and one thing I love about watching the show is, you guys always go through the cost to, this deck is going to cost us this, that. How are you dealing with not so much just the increase in costs, but the volatility in costs to remodel or build a home?
It has been very challenging the last few years as a real estate investor, and it really started when the interest rates doubled and the cost of materials went way up, because a lot of investors like me got caught in the middle of projects where when we went to sell those houses, a lot of them we actually lost money because we sold for less than we thought.
Yeah. Is demand there right now? Is demand high? Because when we talk about on the show, we talk a lot about inventory levels being low, interest rates being high, and that's kind of hurt both the buyer and the seller.
Yeah, so right now you're seeing all over the news that inventory is increasing all across the country, 20%, 30%, 40%. But also you're not seeing the fact that with the increase in inventory, we still have less inventory than a normal real estate market. And that's because there's just no inventory. And there's no inventory because I think it's over 80% of households today have a mortgage under 4%. And most of the people that have those mortgages, they're not going to sell their house, pay more money to get a 7% rate. And then we're in this huge housing shortage because of the Great Recession. Well, what happened back then? Well, all the builders, they went bankrupt, so they stopped building. So today we're missing houses. Houses are high, rates are high, and now we have tariffs.
You have a business that also allows people to sort of, invest in the real estate market. What is the focus of that? Is that primarily on multifamily businesses, single-family homes, what?
Yeah, so my company, TM Capital, we go where the deals are. So right now, the biggest deals we're seeing is distressed multifamily in foreclosure, or in California, we're taking advantage of ADU laws. We're buying houses, we're adding units, and we're renting them out. So we just focus really on all aspects of real estate.
And when you say the ADUs, these are these alternate dwelling units that you can basically put a new home on an existing lot that already has a home on it.
Yes, and it's becoming more common everywhere around the country because, for example, in California, you couldn't take a house in a normal neighborhood and build 3 units. They would have never allowed that. Today, they're begging the people to do it because we're out of land, we're out of time, and we have too many people.
I understand why California would do that, and even a place like New York where, we've kind of already embraced density for better or for worse. But do you think some of the other states that maybe are a little bit more sprawling, those cities and states more sprawling, do you think they would also be open to maybe having more density? Because I always feel like there's pushback at least amongst the residents.
Yeah, in the future, absolutely. When it's needed, I think it's going to come because at the end of the day, there's only so much supply, there's only so much demand, and if we have a major housing problem, we have to figure out how to fix that problem. The only way to fix it is by adding more units.
When you're working on a project, what is your biggest cost? So what's your most volatile? Is it the actual materials? Is it the lumber, the drywall? Is it the labor? What's the biggest thing you worry about when you head into those projects?
Honestly, the biggest cost would be the cost of time for 2 different reasons. One, all the delays with the cities getting the permits. So that's the biggest cost. But what's the second reason? It's also the riskiest because if you're put 4 or 5 months behind on a project, something significant happens in the market, your resale value goes down, then you're at risk. So in order to be as risk adverse as possible, the goal is to get in and out as fast as you can if you're trying to flip. But the one thing I learned about flipping, don't flip houses. If you want to make money, you flip houses. If you want to build wealth, You buy and hold real estate. So that's my number one goal today, is to buy, hold, and wait.
Okay, and so you've kind of made that transition. You're still flipping. Obviously, you have the show Flipping 101, and you've had a lot of other shows as well on HGTV with your wife, and they're very entertaining. I don't want to get into how TV is made, and we know that there's some embellishment. I work in television as well. But when people watch that, are they getting a realistic view of what the risk and the potential benefits are?
They're seeing the entire process of flipping a house, except for the number one most important and most difficult part. That's finding the house. So the magic in the real estate business isn't about the design. It's not about listing it and marketing it. It's about what you pay for it. So in order to be a successful investor, you have to learn how to buy right.
But there's a lot of competition out there, or at least there was. I mean, I remember a few years ago, it seemed like everybody was flipping houses, just as a side, not even as a full-time business. Is it still that intense, the competition? Because I even see you on the show, you'll be like, oh, I found something, you better get over here right now or we're going to lose it. Is that still the case?
I got to tell you, it's probably more competitive today than I've seen in a very long time, because there's no inventory. So you have so many people fighting for the same deals.
Are you primarily concentrated in California, meaning the projects that you're doing?
Flipping houses, Southern California, buying real estate. I own a couple hundred houses all over the country, a couple thousand apartments, self-storage units in different markets, typically along the Sun Belt, like Arizona or Texas, or we have a really nice project. We bought 371 units in Northwest Arkansas.
So longer term, when you look at demographics and changing trends here, like what part of the country would you be most bullish on as a real estate investor?
Yeah, I mean, today the Sun Belt region has done really, really well. But here's what I learned during the Great Recession. The markets that go up the fastest when things are hot are the ones that go down the fastest. But they also rebound the highest. So my goal is to identify what markets along the Sun Belt, like Arizona, for example, Phoenix, went up crazy high. And now it's going down. That's where I want to buy, because it's already shown when the market's stabilizing, the demand is going to go, and that's where you get the big win.
I have to ask you, obviously you have a big presence in Southern California. We just had the wildfires, which decimated several communities there, including Altadena, Malibu, and a few others. There's going to be a rebuilding effort at some point once they finish with the cleanup and the investigation. I mean, what is the mood like down there in Southern California right now?
You know, we're in Orange County. We're not really feeling it as much as LA County. I know LA County, they're going through it. We have a lot of friends down there, and it's a heartbreaking situation. I mean, it's way worse than most people think. So I think as a community, everybody's really focused on rebuilding and rebuilding a brighter future.
I wanted to talk a little bit more about Flipping 101 and your show. And why do you continue to do it? Is it? I mean, you have these other businesses, which I assume you're living well off of. Is there still value in doing these shows, HGTV shows?
You know, honestly, I have a lot of fun doing them. I've been on TV for almost 15 years now. I'm passionate about real estate. I'm passionate about teaching, and I really want to share my knowledge with the world. And if I can reach them through, through television, then that's the way I want to do it.
When fans see you in the street or the airport or whatever, like what's the main thing that they ask you? What do they want to know from you?
Aren't you that guy? Hey, should I buy a house? I said, only if you can afford it.
But and are you actually helping you're producing these as well, or are you?
For the Flip Off, the new show that just aired, I was one of the creators of that show, producers of that show, talent of that show, and creative on that show.
All right. Well, Tarek's new show, Flipping 101, the new season of that show, I should say, debuts on Thursday on HGTV. And if you watch HGTV for any length of time, you'll see he has quite a few other shows that either existed or were in the past that you can also take part in. Tarek El Moussa, there, real estate investor and the host of shows on HGTV. All right, let's take a quick look at how the markets ended on the day. It was another volatile day on the Wall Street as we wait for the roller coaster ride in Washington to end. A clarity day, a liberation day. Most of the folks we've spoken to today, not so sure. We got a gain of about 0.4% on the S&P 500, but still pinned at that 5,600 level, below the 200-day moving average. And a lot of the tariff-sensitive sectors really taking it on the chin. That includes pharmaceuticals, that includes the automotive sector, and as well as some of the retailers and consumers' discretionary stocks like airlines. We'll be back in a moment. This is The Close on Bloomberg. All right, investors bracing for more volatility tomorrow as the White House says President Trump's tariff announcement will take effect immediately. A 4 p.m. press conference scheduled for tomorrow in the Rose Garden of the White House, where we're supposed to learn about these reciprocal tariffs. Jonathan Levin over at Bloomberg Opinion writes that the tit-for-tat and negotiations to follow likely to generate even more volatility that could play out over years. Whatever happens on Wednesday, it would be an error to let our guards down, so he says. Jonathan joins us right now to talk a little bit more about this, his latest Bloomberg Opinion column. And, you know, it's funny, Jonathan, at the start of last week, we had a big Wall Street strategist on who made the case that tomorrow might be a clearing event, the clarity that somehow the market had been looking for, and somehow we can all go back to our normal lives. But now I'm hearing from a lot of people, including you, saying that this might actually just be the start of it.
Yeah, I think so. I mean, look, I use my piece to look at the precedent of NAFTA negotiations. I think a lot of people think and actually hope that this reciprocal tariff idea is about starting negotiations whereby other countries may actually lower their tariffs, their barriers to entry for our exporters. But look, if you're going to get any kind of outcome like that, it's going to play out over years. The precedent, again, here, I think, is NAFTA, where, you know, President Trump comes in 2017. He has this big promise to either back out of or renegotiate NAFTA. In August of 2017, they start negotiations. But the volatility over the course of that thing would play out for essentially 12 more months. And there would be times, as we know from the comments of Robert Lighthizer, Trump's own U.S. trade representative at the time, there would be times when NAFTA in 2018 was really still hanging on by a thread. And so I think it's naive to think that whatever the outcome is tomorrow, that is the ultimate outcome.
And it was just to point out, too, and for investors, or at least for those who have a Bloomberg terminal, you just go back and look at what the benchmark indices were doing in 2018, basically bear market territory. And more importantly, though, it was that oscillation that we continue to see week after week, month after month, that just kind of kept investors, to a certain extent, on the sidelines. I am curious, though, about the response. We're putting so much focus on what President Trump does in the Rose Garden tomorrow, but we still don't necessarily know what Mark Carney's going to do, what Claudia Sheinbaum's going to do, Xi Jinping, or what the European leaders will do in return. And I'm wondering if there is actually negotiation, Jonathan, or whether this is just going to be, you know, one person makes a salvo and the other makes a salvo, but there's no real direct negotiation between the parties.
Here's what's so hard about this, Romaine. I could see a scenario in which, you know, the Trump administration has gone around, they've figured out what the tariff rates that everybody else has on our exporters, and they say that's what we're going to do. Okay, if you do that scenario, you're talking about effective tariff rates maybe getting bumped up a couple of percentage points. I think at the end of the day, everybody does that deal and they say, great, let's move on. But we're not just talking about that. We're talking about all these other non-tariff barriers, anything from, you know, food inspection standards when you know, when our exporters' agriculture products get to other countries, to value-added taxes. If you start adding in all of these other things, which, by the way, are highly subjective, and it's going to be very difficult for anybody to agree, you start layering these things on, and it could get you to an outcome that looks something like, you know, the 19th century, William McKinley, Donald Trump's, you know, great inspiration in so much of this. So we don't know what tomorrow is going to bring. And if you introduce these other factors, it makes it so much harder to agree at a deal.
Yeah, and we should point out, I mean, we're already on pace, even though we don't know exactly what's going to happen. Based on the estimates, we already know this is going to be way bigger than what we saw back in 1929 with Smoot-Hawley. And of course, we saw the economic effects of that. Is there a case to be made, John, that maybe the economy has changed? Maybe we won't get as negative of an impact as what we saw back in the 20s and 30s, or even prior to that, back in the 1800s?
Well, look, I'll tell you this. I will be the first to admit I don't know exactly how this economy is going to react. I think people err when they say it's going to lead to you know, such and such an inflation rate, or it's going to lead to such and such an impact on the real economy. but it's going to do one of those things. I feel fairly confident that it's going to have one of those two outcomes, and that the ultimate outcome is not going to be particularly positive.
One final question here, John, and this is this idea of the tool. I mean, a lot of people, at least the folks in Trump's orbit, talk about this as basically a negotiating tool. You had made the case in a previous column last week, I believe, about the value-added tax, which we don't have here, at least not in the traditional form that we see over in Europe, Latin America, and a few other places. Is there a case to be made that that could potentially be a more effective tool than just tariffs?
I think so. I mean, look, the obvious thing here is that Donald Trump is scapegoating every other country. And there are reasons behind our trade deficits, and by the way, our fiscal deficits, that come from choices that we have made as a country. Domestic choices, tax policy choices. And so if we want to make real enduring change, something that we might think about is maybe we do a value-added tax here, like, by the way, every other country in the OECD.
Jonathan Levin, Bloomberg Opinion columnist, a couple of great columns over the past few days, including one today, focused on reciprocal tariffs and the idea that, well, we've been here before. History could be a marker for what happens tomorrow, or maybe we are in a new era. We're going to set you up for what to watch tomorrow when we come back after the break. This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
This is another read on the U.S. labor market.
Workers are staying longer than you expected. How do firms actually deal with that new data point?
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
I do go back to what the lag time is between the soft data and the hard data. What's the lag data for the Doge effect?
That will speak to the anxiety of the labor market right now.
The March Jobs Report, Friday on Bloomberg.
All right, let's set you up for what to watch tomorrow, or at least over the next 24 hours. And we start in Washington at 8:15 a.m., the ADP unemployment report. Of course, this is private industry data, as it begins the drumbeat to that monthly payrolls data out of the government on Friday. At 10 a.m., we get an update on factory orders and durable goods. Remember, we got that ISM manufacturing data this morning that did show significant contraction in that sector. Also in Washington at 10 a.m. Washington time, the CEO of Boeing, Kelly Ortberg, is set to testify before the Senate Commerce Committee. Of course, he is the relatively new CEO taking over to address a lot of the issues left behind by his predecessor. We do get Fed speak tomorrow, including from Fed Governor Adriana Kugler. And of course, the star of tomorrow is going to be at 4 p.m. Washington time, the Rose Garden at the White House. President Trump set to announce the reciprocal tariffs at a, quote, Make America Wealthy Again event. The EU has said it'll use a broad range of options to retaliate if necessary. Special coverage of that announcement begins at the top of the hour right now.